All right, guys, let's get into the charts. Everyone came here for some trade ideas, so let me show you what I'm seeing in the stock market, and we will get right into it. Facebook. So right now we've got resistance at 223.50. We'll call it 223.40. We broke down the other day, and we've recovered it as of today. So we'll see if this can hold here or if this fails. I suspect it will fail here, but again, we don't have failures in the other fangs, so this might have just been a whipsaw signal and we might recover. You have to wait till the close on this one most likely to see where this thing wants to close. If it closes and rejects here and starts to sell off, then that would be a successful breakdown, a successful backtest, and then a rejection. So that's kind of what we're looking for. But I'm not so much interested in this one quite yet, just because I don't see weakness in tech in general. So waiting for the rest of tech to start to look weak before I look at this one. But that's an idea there. Let's look at this XL, or let's look at Apple. All right, so Apple holding the bull trend. It just continues to grind along the trend. So we're just watching that, but as of right now, still bullish. There's the hourly chart, so you can just go ahead and watch that, and that's really, there's nothing to really do here. It's not, I mean, for me, there's no objective area to go long because it's just pretty much continuing to make, pretty much all-time highs, and the trend is bullish, but there's divergence in play, so I'm not too interested in being long this when you have negative divergence in play. I think we're going to break down, and I'm just waiting for that breakdown. Microsoft, same deal. Divergence, negative divergence, riding the uptrend, continuing to grind higher. But for me, it's just I'm not interested in this one. I think there's more opportunity on a breakdown, and we just don't have that yet. Let's look at XLK. XLK, we're looking at this 179 plateau area on the hourly chart. You can see that we're just holding this. So you want to see a breakdown of this. We did break it right here, but it snapped back and recovered. So, and I think that was probably a daily close. Let me look here. Yeah, you can see it hasn't really, it hasn't closed the day basically. We had one day where it closed below, and the very next day they bought it right back up. So still holding that 101.80 as support. So we need to see a breakdown there. Qs, 242 right here is the level. It's about 242.11, and we're still holding that. We started to break down, but we recovered that, and we continue to hold that. So, and again, same thing. We had the one-day breakdown, and the very next day they popped it back up above support and recovered it. So there's nothing to short here. There's nothing bearish while we hold this level. But, we have to continue to watch for this breakdown, and we just sit there and wait for it. We've got negative divergence in the Apple and Microsoft, so that tells me that a breakdown is coming in Qs because those make up 40% of the triple Qs. So if they break down, the Qs will break down. And if the Qs breaks down, the SPY will break down. So let's look at the SPY here. And we look at here's the hourly chart. Okay, so this thing, I don't like seeing the SPY at this 307 again. I pointed out the other day when we popped up to 307 at the end of the day that was a really good area to short, and that played out. That was exactly the right move. That played out for a drop of about 2.5%. But now they've held this 350 support line and popped it back up to 307. So as I zoom out, you can see we're just chopping up and down between 307 and 300. But I don't like seeing it back up at 307. So if they recover this into the close, that probably sets the SPY up for a move up to about 312. And then we'll watch it there. And if they hold 312, then we might get a gap fill all the way up here to 318, 319. And at that point, it starts to put into question this island top reversal. So I'm just playing out the scenario that might happen. just kind of running through it. If we pop here, we could pop up to here, and if we pop here, we could pop up to there. It's just something to watch for. Each time you get to one of these levels, you look for signs or signals of what it's going to do around this level, and that's important. So, but again, we could fade right here. If you see, we basically popped it right up to 307, and the next candle we faded. We're kind of hanging in there, but maybe that wants to roll back over to 300. So anything can happen. I mean, we are at resistance at 307. And unless they break that, then that will hold as resistance, and that should move us down to 300. But we need to see tech break, and if tech doesn't break, this isn't going to break. SPY's not going to break and go down unless the Qs and XLK and Apple and all those market-leading stocks break. And if they don't break, then SPY's going to just hang out here and probably, grind higher. Before I move off SPY, though, I just want everyone to... It's important to always look back at the bigger picture. Keep that bigger picture in your mind so that you can understand why you're trading a certain side. Whether that's looking for short trades or looking to go long, it should all play off or pivot off of the bigger picture. And you get that bigger picture from the larger time frames. And that's why when you're running technical analysis, I know a lot of people that don't do technical analysis, they just lean on the Fed and they'll say, oh, the Fed is your friend, don't fight the trend. And that's fine, but they don't, you have to take into consideration the bigger picture. And here's your bull market trend in S&P 500. Here's your breakdown. This is your Fed-induced kickback year. This is when the Fed pretty much popped this market up. Then you get another big old breakdown and then a big Fed-induced rally. So both of these rallies here and here, the rallies that were below the bull market trend have both been induced by the Fed. So the Fed's fighting to do anything they can to keep this bull market intact. But the bull market's been broken. The trend has been broken. So they really have to do a lot more if they're going to recover this and recover this trend line. So I think it's probably not possible, but I mean, it's possible. It's just they would really have to print a lot more money in order to pop this thing back up. And it's just, not probable. So the trend has been broken. We're now sideways. This is not a new bull market. This is not what a bull market looks like. I mean, if you go back and look at this bull market here, you don't see moves that are just vertical in such a short period of time like that in a bull market. This was a bull market. This right here is probably the closest to the move that you could find where it was vertical. And yeah, I guess you can say that maybe this move is the beginning of a brand new decade-long bull market or 6-year bull market. But, only time will tell on that. We have negative divergence right here. If you look back here on the weekly chart, see the RSI and the PPO, we didn't have negative divergence. You can see that we had positive divergence right there. And we also had it in the RSI right there, indicating that this rally was going to take place, and it was on the weekly time frame. So that tells you that this is when you saw this, that would give you a clue that we're probably starting at least some sort of substantial rally. Here you can see we have negative divergence where we've got prices moving down, and the PPO is also negative, just slightly. Okay, I got my chart back. Right there. There's your negative divergence. So the point is it's different. It's not the same as what we saw back there. So this most likely is still a bear market rally. And even though it's been a very strong rally, the S&P 500 has not made all-time highs. The S&P 500 has put in a reversal chart pattern right here near the all-time highs, but did not make the all-time highs. And we've started to make our way lower. So there's nothing that says this is not a bear market, the beginning of the next leg down in the bear market. I see signs that tell me that this is, and so that's what I look for. But again, you got to look at the hourly chart, and we'll narrow it back down, and we'll just have to wait and see what happens against these levels. This 307 is important. 312 is important, and then obviously the bottom of the gap, about 319 is important. And then on the downside, 300 is your nearest support. Let's look at XLV. Another heavily weighted index in the S&P 500 or sector. Again, just sideways. This thing has just pretty much gone nowhere. It's just flatlined. So we've got a sideways channel, trading channel, very clean levels. So we just wait for the breakdown of 96.85, 96.80, somewhere right in there. When you get the breakdown, you know, that will most likely come with the next leg down in the stock market. And XLF to round out the three most important sectors. We have the breakdown of support, which is right here, and we're just kind of grinding underneath it. We had a kickback rally right here, another one today. Still below that support. They're not able to recover it yet, so still bearish on this, and it still looks weak. But we'll have to wait to see how the day closes. If they're able to pop this back up and recover it, then this would probably have proven out to be a false breakdown. And then you should probably see, you would see a bullish move higher. That would most likely be coordinated with higher moves in the SPY, and does not mean that we're going to recover the bull market or anything like that. But that just means that maybe the SPY wants to run up to 312 or even 319. So just want to cover that. Walmart, relative weakness again. See this down, 0.3%, and the SPY up, 0.6%. So Walmart continues to show relative weakness, and it continues to be a clear and steady short trade. So we'll just continue to stay with this one, and it's just consolidating a little bit below this support line, which is at 120, 121. Just consolidating. I expect we'll probably start to get a drift or a move lower here shortly. Here's XOM. This is interesting. You can see here, I pointed this out the other day, and I had these levels. You can see right here, we actually broke down below this support range, but they instantly recovered it. So it looks like a false breakdown. And then this is starting to break out to the upside above this downward price channel. So this is actually looking bullish for in the short term at least. So if we go to the daily here, we do have it's not really negative divergence because the prices have been moving lower. So there's nothing really in the indicators telling me that this is bullish. We don't have positive divergence. That's something you'd want to see, maybe seeing the indicators make higher highs and higher lows while the prices are making lower prices. We don't have that, but we do have this trend line right here that is starting to break. No volume though, so we got to wait for volume. I suspect if we don't get the volume today, then either you get a gap up tomorrow or this thing fades. And until then, I just don't see any reason to be in it, and wanting to see some more. I need to see it firm up a little bit more and see maybe some volume come in on the buy side if I'm going to take a long trade here. But it's something to watch. There might be a trade here, so we'll keep an eye on this one. And we got to do our homework on gold because gold is continuing to move higher. So gold's clearly in a bull market. You have to understand that. And gold is very strong. Gold miners have been strong as well. Although gold miners have lagged gold, the price of bullion. So maybe there's some catch up there on the miners. So let's look at this. This is gold bullion here. And I'm looking at a weekly chart just to really get the bigger picture of what's going on with gold. So here's what we've got. This is the rounding bottom that was put in on gold for a while. This is, going back to 2013. So big 6-7 year long rounding bottom consolidation period where gold was being accumulated. And now it's clearly broken out in a bull market. But we're at resistance here on the weekly chart at 1790. That was the level that held back here during the 2011 highs. It's not the all-time high, but it was a consistent level of resistance. We hit that 3 times. You can see rejected here, here, and here. So that's where we got it at 1790. A break above 1790, there's really no resistance. I mean, yes, there's the all-time highs, but we just tagged that briefly. That doesn't really mean people will watch it, but I don't think it's going to hold as a level of resistance. I think we're at that kind of peak area of 1790. A break above that will be, I will probably be considering a breakout, and we should, break above the all-time highs. And the miners should really start to run at that point as well. And the miners actually look like they want to start running, before we actually do that. So here is some of the miners. This is Agnico Eagle. And we got this downtrend line. We had the gap up. I was looking for a back test of the trend line, but it doesn't look like we're going to get it. We've started to impulsively move higher. This looks like we're flagging right here. You can see the pennant that it's making about there. And this should start to break out to the upside. So this, to me, looks good for a break up here to this 69 level. I think we're probably heading up that way. Here's Barrick Gold. You've got a bearish rising wedge here that I marked out. Maybe this plays out. We'll have to wait and see. I'm not in this one right currently. I do own some of this AEM. I bought it yesterday when I saw this price action where we were just basing out and not really falling. I bought it yesterday and, grabbed that percentage today. Barrick doesn't quite look as good. It has a bearish rising wedge. But we don't have divergence. There's no negative divergence in there, and we're breaking to the upside. But again, when I see breakouts to the upside of a bearish rising wedge pattern, I'm very suspicious. So this could run up a little bit more and then maybe fail. I'm just going to kind of watch this. However, we do have this 28 level up here, so we might, it does look good for a move up to 28. Maybe we want to run up and pop 28, pop above it briefly, and then fail. Or again, gold is in a bull market, so when you're in a bull market, bearish patterns can often get burned through or negated. So if you have a bearish pattern but you're in a bull market, oftentimes you can just burn right through that bearish pattern and it doesn't play out. So bearish rising wedges don't always play out. They're just it's just a probability game here. So I'm going to watch this to see what's going on. And I'm looking for that breakout, going back to the gold bullion. I'm looking for the breakout of the 1790 on the weekly. If we get the breakout and it can stick, that sets the gold miners up for a pretty solid move higher. So definitely I'm watching for that. I think it's going to happen. I'm expecting it, but we'll need to kind of see that play out and wait for that trigger before completely loading the boat on gold miners. I've got a good sized position on this AEM. I like the chart pattern. Looks good for a bullish breakout, but I'd like to probably add some Barrick too. Just waiting for bigger picture signs in gold bullion. And that's all I got, guys. Give me a thumbs up if you find value. Appreciate it. Catch you on the next one.